companies are exposed to. And I'm very happy the choice of companies you have had. The good thing is that you have chosen one day I was having a look at the list of the companies you chose, and there's hardly any sector which you haven't touched upon. So that can also help you to pursue further assignments. And if you happen to do your thesis on a similar comparable topic, then this assignment can also support you for the further task as well. Yeah, it's a good choice. But before I start, do you have any questions or any queries you want to ask me? Yes, if you look at the template sheet, the British Petroleum, you will also see the graphics at the bottom. So the graphics would be in a position to give you how those ratios look like, how the trend looks like, yeah? And based on the trend, you can draw some conclusions. Well, one conclusion can be that there's no need to do anything, everything is fine. I mean, having a no conclusion is also a conclusion, isn't it?
So we're quite free to analyze it as we like, do you mean? Like there's no like set rules that you need to.
The question is not about liking. The question is that can you, if you are certain the same thing can be good or bad at the same time. Do you get my point? I think I always give the same example that if you find that the company's debt to equity ratio is increasing, which we shall do hopefully today, this may mean that, hey, what is happening in the company? The company is borrowing. Will it lead to some disaster? Well, the one interpretation is yes, it can. But we always have a positive side as well. The positive side could be that the company's debt to equity is increasing because debt is cheaper these days. And the other interpretation can be that the debt makes the managers more disciplined. Imagine I'm a manager of a company and half of you are my debt holders and half of you are my equity holders. I would feel less pressure to pay you guys because it's your risk to invest in the company. You have the very fact that you are equity holder signifies that you are prepared to take a risk. But the very fact that they people are my debt holders shows that no, they are risk averse. I have to generate certain X amount of cash flows so that I can pay them back. Do you get my point? So therefore, the same thing. And if I'm a manager who's under the pressure to pay back to my certain category of investors, it will make me more disciplined. You see what? It's like a pressure. Imagine a course where there is no assignment required. There is no grading. It's only pass and fail. Basically, everybody pass. You just need to be present and make your faces visible. Yeah. On the other hand, there is a course which is very rigorous. Lots of assignments. I'm not saying that which one is better, which one is not. But in the course, where you don't have any performance kind of thing, hiccups that you don't have the sleepless nights. Yeah. You will not have any pressure. You don't have any kind of urge to do or learn something because you know that this grades I will get anyways. The same thing happens for a manager who have more debt. On the one hand, the one argument is that he's pushing the company towards risk. But the other positive side could be that maybe a debt is cheaper, number one. Number two, maybe the business opportunities are so many that raising the fresh equity is a difficult job, but having a debt is faster. So they are needing more quick money, basically. Because see, you have the company which has certainly growing opportunities. Would you wait for having a new issue of shares and selling it in the stock market? That can be complicated. What you do, just make an arrangement with your lenders and borrow. Simple. It can be done overnight. So debt is quick. So therefore, everything has its good things and the bad things. So you need to discuss in the light. If your debt and equity ratio is constantly going up, just imagine, and your operating profits are constantly going down, it's a risky thing. Then you have to see that, hey, what is happening? The company's debt equity ratio is going up, but the company's profits are going down. How would you pay back? That's a question mark. On the other hand, if your debt to equity ratio is going up, but your operating profit are showing very good graph going upwards, I don't see any problem. So you have to see the total picture. This is why it's very important that you are drawing the graphics and put them in perspective. If you're a little bit more innovative, you can even try to put all the ratios in one graph and see the trend and find where are the conflicts. In the current template, which I shared with you, there are separate graphs for separate ratios. You can be innovative if you try to be. First of all the liquidity ratios you can also put in one graph. All the solvency ratios you can put in one graph. All the leverage ratios you can put in one graph, and then see, is any within the category conflicts? And then go a step forward and put all the ratios in one graph. That would be a fantastic thing. And then you are able to know which are the good things, which are the bad things, which are good, but you need to be careful, which are bad, but not so bad, and which are really, really threatening. So you need to see the larger picture by combining all those ratios together. This is why it's very important that we are not just studying the ratios per se, but we are also applying them in some case company so that we can see their good sides and the flip side. Good question. Anyone else have anything to before we start? Some idea to discuss, please feel free to share. Share screen. I have forgotten how to share. Okay. So I start with the liquidity ratios. In one of our lectures, we discussed what is liquidity. And the idea was that liquidity shows the immediate paying capacity of the company. I hope we haven't done it before, have we? No, I think we haven't, even if it doesn't matter. So the liquidity is the immediate paying capacity of the company. I can give you some simple example. Imagine you are a very wealthy person. You have a palatial house. And if you measure the value of that palace, that building, it could be a couple of millions of euros, but you don't have enough regular income to have a repair of the building. You get my point? It means that you are very financially strong person, but at the same time, you don't have the liquidity to get the regular things done. You have a huge building, but you don't have enough money to pay salary to the janitor or the caretaker. So that is the thing, that liquidity shows your immediate paying capacity. We need to spend some money in the corporate sector on daily basis, on regular basis. And if we don't have enough liquidity, we can be in trouble. Liquidity basically means that at any stage, your current assets must not be below the current liabilities. So always your current assets to be more than the current liability. So that the money which is coming in quite frequently is more than the money which goes out quite frequently. Because otherwise, you could be in trouble and you have to negotiate and renegotiate the lending arrangements with your bankers, and your bankers would be very annoyed. Hey, what is this doing? Last week, this guy came to have a credit limit of 10,000 euros, and today he came again for 30,000 euros. What is happening? And if you keep annoying them time and again, then they would charge more interest from you, or your rating, your credit rating can go down, or at least they start avoiding you through their behavioral, thing, through their optics. So point I'm trying to make is that a company can be super rich. It can have billions of dollars worth of assets, total value, but it doesn't have enough cash to pay money to its employees. It can't repair its machinery. Even the regular day-to-day expenses, it's struggling. I remember one very bad example which caused catastrophe on this planet, just because the company was suffering from the liquidity crunch. That example is, I think it was about 2000, I have to check, I think it was definitely after 2010, maybe 12 or 13. The name of the company is the one which I have chosen. You know that? And the case was Gulf of Mexico. Fantastic company, billions of dollars worth of assets, presence all over the world, nothing to complain. But there was something to complain. The company's regular cash flows were going down. The company was having severe restructuring issues. The company was trying to save every single cent from spending because it was in a pressure to, to overhaul its long-term investments. So company was trying to save every single cent. And then the engineers who were in Gulf of Mexico at the oil rig, those engineers are talking to the finance people. Hey guys, we told you for last 3 months ago, we have been repeatedly asking you that there is some leakage going in the pipes, and it will not cost anything. Altogether, it will cost a couple of $million, which are peanuts for a company like BP. Can you release that money so that we fix those pipes, because we see that some leakage is coming out? And as usual, the finance people, oh, it's okay. If nothing has happened so far, nothing will happen in the future. Let's wait. And guess what happens? One day, those pipes collapsed. It was, in the recent history of the mankind, it was a massive man-made climate catastrophe in the world. And while the company was saving a few cents, it ended up paying billions of dollars in penalties and other libels. Do you get my point? And company is still going through the several court cases almost all over the world. And besides that financial loss, look at the loss which has been inflicted on the flora and fauna. Seawater was polluted. Marine life was absolutely devastated in that region. If you look at the videos on YouTube about Gulf of Mexico crisis, it's heart-wrenching scenes. So this is the problem, that sometimes the companies, because of they press the panic button and they try to postpone certain essential spendings because there is some blockade in the regular flow of income, or at least they're afraid that there would be some blockade in the regular stream of income. So therefore, it's very important that the companies must take into consideration the liquidity ratio. They are super important. As I said, that you can have billion-dollar company, but you might not have a couple of million euros to pay to your staff. Well, they might leave. What will you do then? So the current ratio is the first measure of the liquidity ratio. And the current ratio is very simple to find. You have a look at the current assets, which you see in the balance sheet. I hope you know what is current and non-current, and simply divide it by the current liabilities. And the textbook, the rule of thumb ratio is 2:1. Several textbooks say that if the ratio is 2:1, I mean, for every €1 of current liabilities, there should be current assets of €2. If this ratio is 2:1, this legend is fulfilled, then you don't have any liquidity problem. Even though I personally don't agree with this legend, because this legend 2:1 assumes that all the companies have the same cash flow structure. No, it's not. If you go to Prisma or Walmart or any other retail company, almost 100% business is on cash. You can't take your basket of goods out until you pay at the till point. But on the contrary, there can be oil companies, there can be heavy engineering companies, like for example, Valmet in the same city. We have Prisma, we have Valmet. If you think carefully, you will see that whose liquidity is more frequent. Valmet has to struggle more to maintain liquidity because it's a B2B type of firm. And moreover, it sells very heavy. It doesn't sell nuts and bolts. It sells very heavy engineering products. And the buyers, even though they are business sectors buyers, they don't make payment at the till point. You will not see in Valmet a till point where you bring some, how to say, a ship-sized machine, and then you pay at the till point and then you move it. Can you visualize it? It's impossible. So in some companies, by default, because of its own nature, liquidity ratio is more. In the others, the current, this current ratio is more, but in the others, the current ratio can be less. But we have a way out. If some of you have chosen Prisma or any retail company, and you find out that over the last 5 years, the current ratio has fallen from 2.6 to 2.2. Even though it's more than 2, you have a reason to be worried. On the other hand, if you have the company like Valmet, and in the last 5 years, its ratio has improved from 1.2 to 1.6. It's an improvement. Do you get my point? For Prisma, if the ratio has fallen from 2.8 to 2.2, even though it's more than 2, you have a reason to be worried. But for Valmet, if the ratio has grown from 1.2 to 1.6 in the last 5 years, it's a good sign, even though it's below 2. So therefore, this externally imposed legend sometimes can be misgiving. Invariably, you open a book, you will see that the legend is 2:1. I don't agree with this. And sometimes you also compare yourself with the industry or the sector. If you are in the retail sector, you can compare the current ratio of the entire industry and see that if you're doing better than them, even below 2, it's okay. But if you are doing worse than them, even it's more than 2, you need to be careful. So therefore, it's very important that how you see the current assets and the current liabilities. A student asked me that how to make the analysis and the comparison. This is what I'm saying is analysis and comparison. That you might end up seeing a company and that company is in the retail sector, and you find that its ratio has fallen from 2.6 to 2.2 in the last 5 years. So graph is going down. But then you recall, hey, I read one textbook, it says 2:1 is good. No, it's not good in your context. Because look at the trend. The long-term trend is that for the last 5 years, the ratio is going down. You need to be worried of. Yeah. So, well, of course, it's larger the better. Definitely, if it is below 1, it will be very unsafe. It's not showing?
Showing, but it's on liquidity ratio.
Oh. Just a sec. Share my screen. Does it work now?
Yes.
Is it in Zoom now?
Yes.
Yeah? Okay, good. As I said that even though the financial ratios are quantitative, you need to go beyond and see the qualitative aspect also. Many managers, there are some good reasons to have the high liquidity ratios or the high current ratio, but there can also be some bad reasons. Yeah, I hope you know that the accounting data is very useful, but the one problem with the accounting data is that it is subject to manipulations. There is always some likelihood that the accountants can manipulate the data. The good reasons of the high current ratio is that you must have the quite sizable buildup of inventory. Imagine you get an order just overnight that, hey, you need to supply something, and you don't have the inventory. Remember, inventory is a part of your which item? What is inventory? Yeah. Yeah. So which type of asset is this? Inventory includes raw material, semi-finished goods, and the finished goods which are not sold yet. Raw material do you use after 1 year? So what is the definition of current and non-current? Within 1 year, most likely you will be using. Yeah. Imagine a store which has brought vegetables and they use after 1 year. So who will buy them? So the current assets are the one which we use more frequently. Raw material, semi-finished products, and the finished goods about to be sold. Maybe they are not fully packed. That is called inventory. So inventory is a part of your current assets. Okay. Now, if you have a good current ratio, it means all the likelihood you would be having a lot of inventory as well. And the company is getting the order. You will be in a better position to meet the rising demand. You will be able to fulfill the order without any problem. But imagine you have got the order and there is no inventory in your warehouse. What will you do then? You will be in trouble. You might have to say to the customer even that, hey, sorry, we can't take this order because we don't have enough raw material. Do you think that they will place the order to you next time? Forget it. Never possible. So therefore, having a good inventory is a sign that you are in a position to meet the rising demands in the future. And if there is any immediate business expansion, you can do it. And you will be relying less on the banks and the other sources. Okay, but at the same time, we can also have the bad reasons. You can have the bad reasons also. A manager who finds that the company is going really down, the company is not making progress, and he needs to show something good about the company. He or she can start selling those assets. They can also do the cost reduction program like BP did in case of Gulf of Mexico. You see, the cost reduction ultimately led to the environmental destruction. So sometimes the companies are on the mission to reduce cost. Maybe they take it too seriously, or to hide their weaknesses, they can even sell the assets. When you sell the assets, or when you reduce the cost, you have lots of cash. Your current assets go very high, but they go up. But that is not good for the longevity of the company. By raising the current ratio artificially up, you are hiding your weaker side. Because what you're doing, if you get your current ratio up by selling more, by better control, reducing your cost with better machinery, your efficiency is improving and the per unit cost is going down, really good. But if your current ratio is going up because you haven't paid the salaries to your staff, because you have taken money from the pension fund of employees, basically it's stealing, you are not spending money on the very immediate and very pressing demands, or even worse, you are selling the assets of the company in the what is it called? Which market is that? This second hand, when you're selling those products in the, a company is asking another company, hey, I have some machine. You also use the same machine. Please buy it. We give you heavy discount. With these kind of tactics, your current assets will go up and the current liabilities will go down, and your current ratio would look very nice and good looking. But that is not a good reason. That's a governance issue. Okay? Change your managers as soon as possible. Or people who are controllers. There is an internal controller of the company. They're not doing the job properly. Okay. Or the company is in a very adverse situation and the inventory is accumulating for the last 5 years. For the last 5 years, there have been some inventory which you are not able to process. First of all, it's a sign of your inefficiency. And this inventory is adding up. And this inventory goes to your current assets and that number looks very big. Everything is good, but it's not good. So sometimes this rising current ratio can be misleading. Okay. And moreover, one thing is very important, try to understand. The current assets include what? The current assets include cash. It also includes cash equivalents. If you remember, we discussed that cash equivalents are those assets which can be converted to cash without any much hardships. For example, if you have the bills, or if you have the shares, or if you have some, if you bought some securities, you can sell them immediately and you'll get the cash. But one more thing which current assets include, which I strongly have a concern, but nothing much you can do, is that the current assets also include inventory. Inventory has a problem that you can't sell it faster. If you have 10,000 euros of stocks, shares, you can simply ask your broker that, hey, can you sell these stocks, these shares? He would do it without any problem. It will take maybe 5 minutes to do, or you do by yourself. Nowadays, people are doing online trading and you can manage your accounts by yourself. You can open a trading account and you can trade by yourself. But if you have the inventory and you're willing to sell it, it might take you many months before you find somebody who's willing to buy from you. Or even after many months, you have to sell it at a discount. It's difficult. to sell. So therefore, the one very important problem with the current assets, with the inventory, which is a component of current assets, is that it's not so marketable. It's not so well marketable. Marketability is a problem. Okay, so that is a problem with the current ratio. How can you improve it? Well, there are many ways to do it. The one way is to slow down your debt repayment. Is it even realistic? You can slow down the payments of your debt, but then your lenders would be very angry with you. Acquiring a long-term loan, well, you can ask the bank, because you are having problem now after every month. So you don't want to approach the bank every month because you don't want to annoy them. You can negotiate with the bank if they can release or if they can sanction a loan to you, which is more than a year. But you know that the loan has its own problems as well. If you make taking the loan as a habit, then you can be in the debt trap. If the exception become the rule, it can be a problem. If you keep borrowing more and more after every now and then, it can be a problem. Selling fixed assets, here I was a bit more sarcastic. No, it's not a good thing. Putting profits back in the business, I think that's a very good technique. That when you earn the profits, you can negotiate with your shareholders that, hey, is it possible that we don't give you dividend now? If they understand, if you are selling your idea very well to the shareholders, they may agree. Agree to what? Not to take the dividends, but to reinvest the profit back in the company. So the good thing is that this is almost free money. You don't have to borrow from any banker. You don't have to pay any interest. But the only, the $1 million question is that, will you be able to convince your shareholders that they give up the current profit to have more profits in the future? So if you are asking your investors, hey, my dear investors, you have been earning about 5% from this company every year on an average. What if you postpone taking profit from the company for the next 2 years? Because we have a very good business proposition and we are recycling this money back in the business. There's a very high chance that your profits will skyrocket after 2 years. Can you show patience for 2 years? And if most of your investors are long-term investors, they really care about you, they really stick with you, they believe your ideas, they shouldn't have any problem. But if you have most of the investors who are short-term investors, that can be a problem for you because they will not wait for it. Okay, so the kind of investors you have, the kind of shareholders you have, that can have an impact on the current ratio. I know it's difficult to convince to shareholders to wait, but I know one example, and I think I shared with you, when the shareholders were asking the CEO not to pay them. So the CEO was running after them, and the CEO is saying, hey, we have money, please take it. And the shareholders say, no, we don't want it. We don't want it. Please don't give us. You remember the example? It was a case of Microsoft and Apple. When the companies were growing so fast, the profits were going so fast that the shareholder, the CEO of these two companies, respective companies, they were chasing shareholders to take money. And they were saying, no, 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 we don't want money, keep recycling it. Why were they saying it? What could be the possible reason of it? The possible reason is that that was a time when Microsoft and Apple were super fast growing company. They were growing like anything, exponential growth. And the investors were willing to reuse the money so that the share price of these companies go up. So they were not looking for the annual dividends. They were looking for the big increase in the share price of the company. Mhm. And even then, many investors were not willing to, neither willing to take profit from the company nor sell their shares. Yeah. And in that case, the company has to do a special package, special scheme called share buyback scheme or share repurchase scheme. Do you know that? The share buyback or share repurchase. Mm-hmm.
Sells share by young
Who buys it?
shareholder who sold a share.
No, it goes like this. But imagine that I bought a stock at 10 euro and the company is growing very fast. And after 2 years, I find that the company stock is selling about 70 or 80 euros. It's very high. Even then, I'm not willing to sell. And the company is offering me one option. The company is saying, hey, you bought at 10, the price is 80. We give you an option. We offer you 100 euros, more than the market. Will you sell it? And if I'm willing to sell it, yes, I say, all right, fine. So the company is paying me premium above the market price. And this is called share repurchase, when the companies buy shares back from the shareholders. So see the system. First of all, you buy the share from the company, and then at some stage, the company is willing to buy from you. And usually the companies who do the buyback, they do it. They are generally the growth companies who have shown splendid profit, and now they want to honor or reward their shareholder for the trust and the faith they have shown in them. So it's like a reward for fidelity or reward for being with the company all the time, right? So there can be some situation as well, but now our discussion is going elsewhere. So this is all about the current ratio. And the next ratio is called acid test ratio. It's also known as quick ratio. The quick ratio, as you can see here, the formula, it's still current assets divided by current liabilities. But one very good thing this ratio has done is that it has taken away the inventories from the block of current assets. Can somebody tell me why the inventories have been taken away from the numerator? Any ideas? Anyone in the Zoom want to answer? Why are inventories taken away from the numerator? Yes. Mm-hmm. Yeah, very good. So the reason why inventories have been taken away is that inventories have even though inventories are the current asset, but the one very big limitation of the inventory is that it is comparatively illiquid. So the element of liquidity is very less in inventory. Why would somebody come to you and buy nuts and bolts when they can buy from the open market? Mm-hmm. So that is why the companies find it very hard. So what they do while calculating, they find that the current ratio is not a very pure ratio of the company's liquidity. So therefore, we can take away the inventories out, because almost all other current assets are pretty much liquid. So much so that even your accounts receivable are liquid. For instance, I have some customers who haven't paid me, and I'm in immediate need of money. But then I know that if I go to the bank, they would, and I ask for the loan, they would charge heavy interest from me. But I can do one thing. I can take all those bills, you know the bills? If you are my customer who haven't paid me yet, at least I have sent you the invoices and you accepted them. Have you? What I do, I give those invoices to my bank. Bank is assured that SHAB will be getting so much money in the future at least. So nothing is going to be lost. They can give me money. They can give me loan against the invoices. And when you guys pay me, if imagine that you pay me in time, I pay money to the bank and the bank release those documents to me. But can I do the same thing with raw material? Can I take the sacks of raw material on my shoulder to Nordea and keep with them and take loan from them? Impossible. So this is why the problem with the raw material, the inventory is that the marketability is a big problem of inventory. So therefore, we take away this limitation straight away. So all other current assets minus inventory are fairly marketable, and divide by the current liabilities, and that would give us a ratio. And once again, the legend says that the ratio should be 1, close to 1 at least, even though once again, I don't believe in this legend. I'm citing it because most of the textbooks are citing it. You can ask me, Shab, why didn't you put this benchmark? That's why I'm putting it, but I don't agree with these benchmarks because they assume, these benchmarks assume that all the industries, all the sectors, all the firms are homogeneous, but in reality, they are not. The last measure of the liquidity ratio is called cash ratio. This is the 24-karat purest form of the liquidity. Forget about inventories, out of question. Even the accounts receivable, all other assets, forget about them. Only focus on hard cash, just cash, simple. Cash divided by the current liabilities. So as long as, so here we are coming down to the roots, the most liquid asset, or the current asset that one can have is called cash. So we only have a look at the cash ratio, right? So we can have, depending upon situation to situation, we can decide whether we include inventories or whether we take the current assets, current ratio, or we calculate the cash ratio. It will be very interesting to see that your current ratio and cash ratio are showing different trends. When you draw them, they are showing some contradictory trends. So that would be, if it shows, it could be because the inventories are taking a big space in your current assets. Questions, comments? I don't think this is even a different ratio because, as I said, that at no point of time, your current assets fall below the current liabilities. So the net working capital is also a good measure, divided by total assets, but it has to be positive, okay? Because if your current assets are less than the current liabilities, then your net working capital would be negative, and this is unacceptable. Negative working capital means that you are not able to manage your company on day-on-day basis. So this could be a trouble. And even otherwise, in case you want to know the formula of working capital, it's always equal to current assets minus current liabilities. Okay? Can I ask you a quick question? If I remove here current assets, if I remove current here and current here, and I only call it total assets minus total liabilities, what would you call this then? Can you see the cursor here? If I remove the current word here and current word here, and it become total assets minus total liabilities, what would be this then? Sorry? If you don't have current here in both words, and we have total assets minus total liabilities, what would be this? The final outcome. Have you heard the word equity? Shareholders' equity. Do you know that? Or is the first time you're hearing this word? Is the first time you're hearing this word? It's called total equity or the shareholders' equity. And then the next category of ratios that we will be taking care of is called solvency ratio. And solvency, I explained this word before, that a company is said to be solvent if its total assets are more than total liabilities, which means that the equity is positive. At no stage in your business life cycle, this needs to be negative. If at all, your total shareholders equity negative becomes negative, it basically means that all the value of investors is zero or negative. So they are worthless. So all those shares which you own, they become worthless. So as you can see here, the difference between total assets and total liabilities is called shareholders' equity. And to be a solvent company, to remain solvent, the total assets must be more than the total liabilities, which means total equity is positive. And if a company's total assets are less than its total liabilities, then the company is said to be insolvent. It is because the total equity is negative. Meaning of a company to be liquid and solvent. When is a company liquid? I'll come to you. When is the company liquid? If you have to say this company is liquid or illiquid, what is the benchmark? Yes. How would you see the in a quantitative terms? Mm-hmm.
Current assets more than current liabilities.
At no stage, the current assets fall below the current liabilities. And how would you say that the company is solvent? At no stage, its total assets fall below the total liabilities. Yeah. Yes, you have a question? Solvency is that what you own. Look, it's a very important thing you asked me, so I think I should explain a bit more. The company's total assets shows what company owns. So let's say the company owns is 100,000 something here. And total liabilities are what company owes. Own is your claim on others, and owes is others' claim on you. And since your claim on others is more, in this example, I haven't, let's say 80,000, yeah? 1, 2. So you can see that what you own is more and what you owe is less. Therefore, your equity means the money which belongs to shareholders. Well, there are actually. So complicated what to show and what not to. I think I should, in the future, I should teach like this, so that I can see from the screen rather than.
Why it's not?
Mhm.
This in Zoom, you can see the whiteboard.
Yeah. Mm.
Share whiteboard.
A company is said to be solvent. If you read the last line, a company is said to be solvent if its total assets are more than total liabilities, which means that the equity is positive. And a company is insolvent if its total assets are less than its total liabilities, which means the total equity is negative. And the total assets, as you can see, the total assets are, they must be equal to this ratio. And this equation will be only valid if total shareholder equity is positive, right? If this is 50, this is 40, it has to be plus 10. But if this is 50 and this is 60, then this will be minus 10. Minus 10 means the shareholders have lost everything, basically. So at no stage, the total equity to be negative. If it is, then the company is called insolvent. But one more thing, we still don't call it bankrupt. There's a difference between the word insolvency and bankruptcy. After a company is declared insolvent, then the company is taken over by some, you can call it's different bodies, but in many examples, in many countries, it's called the Ministry of Corporate Affairs. They send their representative and he takes over the company. And what they do, then they start selling. They try to restructure the company. They try to set the things right and try to revive it. But if they decide that, hey, this is a hopeless case, we can't revive it, then they declare that, hey, you know what? The company is not only insolvent, but also bankrupt. And what happens in the bankruptcy? Then you start selling the company's property, assets, everything. And with this money, you start paying to the outsiders. Yeah. And who gets the money first from an insolvent company, from a bankrupt company? The state. The state is very clever. What they do, they try to make they first send their own person to liquidate it. And then whatever money comes, they take whatever the company owes to the state in the form of taxes, whatever, they take the money from that. And then whatever is left first given to the workers, the laborers. And then if something is left, it goes to who? Debt holders. And then if something is still left, only then it goes to the shareholders. So the shareholders are basically, we use the word sarcastically, that the shareholders have the residual claim. And what is the meaning of the word residual? Leftover. the shareholders only get the leftover. It's like you organize a party and there is some group of people who only get the leftover food, after all the guests have eaten. And it could be possible that nothing is left for them. So the shareholders, the ordinary, the common shareholders are the ones who are getting the share of this dying or dead company last in the queue. So we use a phrase, maybe I write it here, or I dare to write it here if I lose the, but I can try because it's so important to share with you. We use a phrase called, let me give you an example. Yeah, this was clear, I think. So in this case, the equity of the company is, oh dear me. It is very valid and I don't want to leave it unfinished. I hope it works now. So in this case, very quickly, I write down that the equity is total assets, 5 zeros, 1, 2, 3, 4, 5, minus 1, 2, 3, 4 equal to 20,000. So this is the equity. So the company is, so what would you call it? Is it solvent or insolvent company now? Solvent. Good job. Now imagine that the company is declared insolvent. And when the company is insolvent, its assets are lesser than its liabilities. So in this case, your equity is minus 30,000. So in this case, the company is declared insolvent. And now what happens? Then this case is reported to the Ministry of Corporate Affairs. They will not come from Helsinki all the way here, but they would appoint some of the representative who would be trying to revive the company. And when he or she says, my hands are up, I think this is not going to be repaired. Let's call it bankruptcy and let's liquidate the company. Liquidate means not liquidity, but liquidate means finish it. Okay. And then what they do, they find out that the companies, they sell all the property and everything, and they find that the company, if they sell all the assets and everything in the secondhand market, you will be getting about 60,000. 60,000. And then they find out that the money which belongs to the state is 10,000. The company hasn't paid. The company owes to the state by 10,000. The first person, the first institution which is waiting in the queue is the state. So now the remaining is 50,000 because they have taken 10,000, remaining 50,000. Usually it's the employees who are next in the queue. And let's say the company owes about 30,000 to the employees. Not only salary, but also pension and everything, yeah? How much money is left? 20,000. And then debt holders. And let's say that the debt holders, 40,000. What will happen now? Yeah. So even a big chunk. So even the debt holder who claims 40,000, but they only get 30,000. So even they are, in this case, even they are having a loss to the extent of 10,000, right? What about the equity holders? Do they get something? No, because all the money has been exhausted, has been evaporated basically, while paying the different stakeholders. So in this case, equity holders get nothing. Okay, and this theory, can you see the pattern that who gets more and who gets less? Yeah, this is a theory, and this theory is called Pecking order hypothesis. Do you know the meaning of word pecking? Have you seen the woodpecker? What does it do? It pecks, yeah, it eats. So pecking order means who eats the company and in what order they eat. So the order of eating, the pecking the company is that whatever money is sold, is received by selling everything of the company belonging to the company. State is the first woodpecker, followed by the employees, the next woodpecker. Debt holders are the third woodpecker. And if something is left over, the equity owners would be the woodpecker. And because the last one in the queue are the shareholders, we call them, what do we call them as? We call them as residual claimants. The one who claims at the last, leftover, residual. So therefore, there is an order. Insolvency itself is not an event. It leads to further chain of events. And it can lead to full-fledged bankruptcy of the company. Make sense? Right. We take a short break. There was one question which, it was not a question. Sorry, can you please, that you want to find out operating return on assets. And operating return on assets, I'm just cooking up a ratio. It's equal to operating profit and divide by total assets. Now the thing is that the operating profit will come from the income statement. And just imagine that operating profit is in thousands of euros. So the unit is 1,000 of euros. And then we also have the denominator total assets. And let's say that the operating profit is actually equal to 200. Because this operating profit is measured or put in the bracket in thousands. So in other words, this is not, if I have to take away the brackets, it would be 200. And there are 3 zeros in the bracket, so I put 3 zeros back. On the other hand, the total assets are given in millions. And these are 30. A very big mistake you can commit is that you can, when you calculate the ratio, and you know that, oh yes, we read in the slides that the total operating return on assets is operating profit divided by total assets. So it's possible that you end up dividing 200 by 30. Obviously, it'd be a big mistake because 200 are in thousands of units and 30 is in millions. So you can't compare two numbers, or you can't use two numbers taken on a different scale. Scale has to be equal. 200, when you take away the bracket, it becomes 200,000. And 30 million, we all know that if you want to write millions, 1 million has 6 zeros because it's a 30. So I have to put 6 more zeros here. 1, 2, 3, 4, 5, 6. So this is a number. So now if you want to find out operating return on assets, you must divide this number, which you see here, by this number. Because this is 200,000. It means the 1,000 is taken away. So if I put it back, then with 200, I put these 3 zeros. And this was 30 million. And I write 30 again, and then I put 6 zeros to make it million. So now when you divide this with this, that would be your true operating return on assets. If you don't have the equal common units, your calculation would be obviously wrong. Okay, even though you can say that, oh, yes, Shab, we followed the same formula which you wrote in the slides. I'm sorry, but you forgot the basic thing, that the units of calculation must be common. Usually, I have seen some of your financial statements, and I can easily say with my hunch that in 90% cases, the income statement data and the balance sheet data is given in the same unit. But I have seen at least 4 or 5 cases. One case I saw today, when the income statement data and the balance sheet data is given in different units. In that case, you need to do some high school maths and use those units and try to recalculate it. Make sense? So it's very important. The first thing you should look, even before applying the formula, you must check that is input data. Input data, I mean all the data which you collect in the spreadsheet to make use of those ratios, to calculate those ratios. Make sure that is it in the same units. If not, then make it. Yeah. Okay. So now if you have any questions about your task, please let us know. Yes.
If it says that it's in 1,000 million, doesn't that equal a billion?
Yeah, 1,000, but you will not get that situation. The maximum, with my own experience, the maximum unit I have seen is in millions. I'm sure the company would be massive if it has 1,000 millions as its unit. That would be really big. Yeah, I think the maximum unit I've seen is million. Have you seen it? Maybe.
I think my company
has 1,000 million.
Yeah.
Can you show it?
First, I have to check it mine. So.
Okay, please check that. I wish I had owned such company whose units are in 1,000 millions. Just imagine, you know. Mm-hmm.
We have to put the amounts in millions or just like it in
Look, if your all the units are common, then you don't have to make any adjustment. So for example, if one figure is 150 and the other is 30, and both are calculated in millions, right? 150 plus 30, 180 millions, that's it. You only need to put extra zeros, yeah, if the two are having different units. If the both are in the same unit, no need to make any adjustment. That's why I'm saying that in 90% cases I've seen both income statement and the balance sheet are having the same units. Is there any data which you haven't really got, you know, which you're really struggling to get? We're getting the data from the income statement. This year I tried my best that you don't look at the cash flow. So all the things you get from the income statement and the balance sheet. But do you have anything even in these two statements which you're struggling to get? Mm-hmm.
Exercise based on these two statements.
Okay.
We did a whole set of ratios.
Fantastic. Next week will be the last week when I spend time on the financial ratios, and then the week following will be moving on to the to the risk management. So please make sure that if you have any questions, you get it solved now or next week. Yeah, we shall be recording. But do you understand this concept now of which I was discussing before the break? This pecking order hypothesis. Yeah. That at no stage, it's very important thing, even though these things are very simple, but non-compliance of these things can lead to the corporate bankruptcies. That at no stage, your equity has to be negative. So the equity is always positive. Sorry for the spelling mistake, it's solvent, yeah. So the total assets must be more than total liabilities. And the difference between the total assets and total liabilities is called total equity. There are many names for it. We call it total equity. We also call it shareholders' equity. We call it common equity or ordinary equity. We also call it net assets or shareholders' worth. And all these phrases, I'm not coining it now. These synonyms are given in the slides. You can see the different names. And in case the company is insolvent, which means that the company's total assets are less and the total liabilities are more, then it doesn't mean that the company ceases to exist instantly. It still exists. And it exists under the state control or some authority control, and they try to revive it. And in case they are not able to revive it, then it's a bankruptcy, it's liquidation. And then this pecking order hypothesis means that in case when the company is declared to die, okay, it will not survive, then the company is this guy who is appointed as a, what is the word for this? There is a word for it. Who is this? I'll find out. There is a certain technical name for this person. He would make sure that all the company's assets are sold off, sometime even in the junk market. And then they collect all the proceeds. And then the first stakeholder who peck the company is the state. And if imagine that it's 10,000, they get away with 10,000, then the remaining is 50,000. And let's say that the employees, their wages, salaries, pension, benefits, all the things put together is 30,000. Then from 50,000, 30,000 goes to the, 30,000 goes to the employees. And now with this manager, with this person who is proceeding it, the bankruptcy, he only left with 20,000. But then he looks that, hey, the debt holder are having 40,000 claims. Well, what can he do? Then debt holders unfortunately lose 50% of their, and there's no question of giving anything to the shareholders. The question is that you can counter me, Shab, once you said that debt is a safer investment than equity. Then I would say that yes, I stick to my words, but in the rarest of rare cases, I'm using the phrase rarest of rare cases, even the debt holders can lose money. And this is the rarest of rare case because you don't see companies becoming bankrupt on everyday basis. This is an exceptional situation, a truly exceptional situation. Of course, if the business environment is very bad, then there can be series of bankruptcy. Last time, if I remember, there was this chain of bankruptcies almost on daily basis. It was in 2001 when there was a huge chain of bankruptcy. Even the big stalwarts, not the small companies, not the SMEs, even the big giant companies like, well, Enron failed, and then there was this Adelphia failed. Then soon after, by the way, General Motors was about to bankrupt. It was saved at the last moment. Which other company? Lehman Brothers. It became bankrupt. So they, Adelphia, who was the company? I'll find out. There was a chain of corporate bankruptcies. That was the only time when it was not an exception but a norm, almost on daily basis. But since then, I haven't seen. Even in 2007-8 crisis, there were bankruptcies, but not to that extent. Yeah. The big giants didn't bankrupt at that time in 2007-8. Yeah. Right. So. Yes. Yep.
In my income statement, I have, let's say, I have 298 this year. Next year, I have negative balance. So in that mix, in the following year where there's negative balance, do I have to miss the amount or do I have to ignore it?
Are you talking about the other incomes?
Yeah.
Well, the two views, if you take a very textbook, very Puritan view, you should never take the income from the other activities. But sometimes, and I've seen in some of the income statements, that the amount of the other income is so minimal or so insignificant that they combine and they use the phrase total revenue, including other income. So then it's difficult to segregate it. All right. Well, in that case, you can, because you are in a very good position to ignore it altogether. But if you have, even if you include it, it won't change the world. It won't be a big problem because usually these other incomes are very insignificant. So it's up to you. I would say don't look at it, but if you have done it already, then I will not say to change it.
As my pension income for next year.
Mm-hmm.
So I've included the income, and when there's a negative balance, I have my deductibles.
So you have actually considered the other income. Yeah, it's fine. You can stick with that, no problem. Yeah, that won't be a big change. Yeah. But if you go by the textbook, we expect only from the operating income. But won't be a big problem. No, it's fine. You can continue with that. Yeah. Last week, when we talk about financial ratios, there won't be any discussion then after. So make sure that if you have any questions, ask me next week. You could have asked me, but many of you chose not to ask anything. So I assume that you have no problem. No news is a good news. So, but next week we shall spend some time on this ratio, and then I would lose patience in financial ratios. And then we will do some other tasks because I can't get stuck to this one topic only for the whole course. So thank you very much and see you next week.